Let's go and answer a simple question. What is liquidity? Because this is something that gets bandied around a lot and often as a reason to trade something. That oil is the most liquid commodity market in the world. That the S&P is the most liquid stock market. And what you've got to ask yourself is, what exactly do people mean by liquidity? And how does this apply in a trading sense? So, quite simply, what liquidity is your ability to do business, i.e. from a normal sense of something, can you sell something easily and quickly at a price you want, convert it into cash? That's what liquidity is about ultimately. Can you convert an asset to cash simply and without having to move price? So take the example of a house. If you have a £50 million house, good for you for one, but this is an illiquid asset. It is going to be hard to sell that because the number of people that can pay £50 million for a house is very, very low. Therefore, the number of bids that you will get for that house is very low. Liquidity is small. Whereas if you have a £300,000 house, pretty average for the UK, liquidity will be high. You could comfortably sell this and very easily sell this because there are going to be a lot of people willing to pay that price for a house. A lot of people have the means to do it, and it's a pretty normal price to pay. So liquidity is often influenced quite significantly by price and by the amount the price varies within a day. Often I think what is confused is volume and liquidity. And ultimately volume does not mean liquidity. Take for example, if you go and have a look at these two ladders next to each other, you've got the S&P and you've got the T-note. Now each of these futures contracts trades around about the same number of contracts on a daily basis, roughly 1.3 to 1.5 million on average. So their volumes are exactly the same. But look at the liquidity, the ability for you to buy or to sell at a certain price. If you want to buy 500 contracts in the T-note, you can do this very easily at the price you want. If you want to buy 500 in the S&P, you can't, simply because there are not enough offers on the ladder. So that's the idea of liquidity, is your ability to be able to get a certain amount of business done at the same price. Now, there is another aspect to this, and this is where it gets slightly more complex. But if you think about this from the point of view of the size of movement on the day, the liquidity is roughly the same in the sense that your ability to buy, say, 200 contracts in the S&P will move price, but the number of prices that the S&P moves within the day means that effectively 4 or 5 prices in the S&P may be the equivalent to 1 price in the T-note. So if it costs you 5 prices to get into the S&P for the same as it does to get into the T-note, the liquidity is essentially the same. But from a trader's perspective, it's the ability to get your position filled at a single price. That's what people really mean when they talk about liquidity. So there you have it. Simple answer. Don't get sucked into this market is super liquid and this market is not. In general, from a trading perspective, your ability to get your trade on, the less movement in a market, the more liquid, but obviously the less movement in a market, the more contracts you're going to have to trade to be able to make the equivalent money of a more volatile market. So therefore the liquidity can to a degree stay roughly the same in two different markets. So hopefully that's explained that and given a little bit of a sense of what exactly is the most liquid market out there. I'll leave you there. More explainers, click on the subscribe below, click on the notification. I'll see you all very soon.